You look around at your city, crumbling infrastructure and signs of decay everywhere. You can see the poverty, the desperation in people's eyes. Making your way to the capital, you can see signs of a foreign culture creeping in, something none of you chose, yet has happened nonetheless. You wait nervously to meet with the representatives. Over the prior years, your nation's finances have gotten worse. The commodities you export selling for less and less, all while your debt has grown. You meet with the foreign bankers. You sigh a breath of relief as they offer to bail you out. They only ask that you make a few small changes, a little bit of austerity, some new trade policies, and that you open up business to them. You look outside, noticing how much has changed already, your home unrecognizable from the country of your youth. Reluctantly, you take the deal, dreading what you know is coming. You're bailed out. You should be saved. Yet over the following years, the poverty does not improve. And so once again you find yourself face to face with these foreign bankers, this time offering you a deal that seems too good to be true. They offer that all your debts can be forgiven, yet this time they ask for more. They ask to become a part of your political system, to align your trade policy with their interests, to open your industry and infrastructure to foreign ownership. And if this wasn't onerous enough, they ask that you open yourself to foreign NGOs, and that you enact cultural policies, that you become more like them. And now you're stuck. Do you give away your country to these foreign financiers, hand over your infrastructure to foreign banks, and accept that you will take on their culture as your own? Or do you return to the people? Do you look at the hungry, the desperate? Do you pass boarded up shops and tell them that you did nothing? With a heavy heart, you make the deal, and you sell your country. And now, as you look around at your cities, they look foreign. Your schools teach foreign ideologies, your politicians work for foreign businesses, and your infrastructure held by foreign banks. To the outside observer, it looks as though you must have lost a war. Yet, you weren't conquered, for you were bankrupt, bailed out, and bought by the World Bank and the International Monetary Fund. It's 1942, and Europe has been plunged into its grandest war in centuries. Britain's economist, Bank of England banker, politician, and peer, John Maynard Keynes, would begin discussions with the American Treasury official Harry Dexter White. As an Allied victory was beginning to look more certain, the two set about designing the economic order that would take shape after victory. The two thought in the vein of British internationalism, and envisioned an internationalist monetary system, one which drew from British progressivism, and its form which had made its way to the United States. As time went on, Allied victory became only more and more certain, and it looked as though the two economists were indeed designing the economic future for all the world. In April of 1944, the two economists would be joined by more of Anglo-America's most prominent financiers in issuing the joint statement by experts on the establishment of an international monetary fund. It laid out the premise for a coordinated international currency system, one designed to ensure currency stability, and more broadly set up international rules in line with the Anglo-American vision, to secure international trade and finance. They also proposed the establishment of a financing institution, one which could be used by the post-war Europe to rebuild, an enormous international financing pool. Only a few months later, officials and the most prominent financiers of Western nations would meet in Bretton Woods, beginning formal discussions to design the world's new economic order. There would be delegates from 44 countries in attendance. They would design a new monetary system with fixed currency exchange rates and terms for currency convertibility. They would as well build the International Monetary Fund, the financial institution envisioned by Keynes and White, as well as the International Bank for Reconstruction and Development, which would become the financial institution to carry out the Marshall Plan. The Marshall Plan, or officially the European Recovery Program, had come from the proposals of Secretary of State George Marshall. The reasoning went that with the sheer power of the Soviets and their presence in Europe, there was great risk that more and more countries would fall into the communist sphere. and that if countries were economically devastated by war, they would much more easily be subverted by the Soviets. Therefore, it was in the best interests of Anglo-America to finance the rebuilding of Europe and ensure that they would remain within their sphere of influence. In only 4 years between 1948 and 1952, over $13 billion would be provided to Europe, making it a truly enormous financial project, and cementing the institutions of Bretton Woods as fundamental parts of the post-war financial system. In December of 1945, the member nations would ratify these institutions, and the new system was born. With these new institutions in place, the post-war monetary financial order had fully cemented itself as the world's authority. A series of currency exchange rates were implemented, and the US dollar made itself convertible for gold. The Bretton Woods banks began dispersing enormous amounts of money, building up infrastructure in the war-torn nations of Europe. Things seemed to be going quite well, and it appeared as though the United States, running on a quite British system, was at the top of the global order. In the United States, though there had been a period of difficult transition, it was short-lived, and the post-war United States, that by all accounts should have been experiencing enormous inflation as it ramped down its wartime productive economy, experienced very little once the 1950s got going. Meanwhile, Britain, which should have been in far worse condition after all of the destruction it had faced and the death of young men, was able to transition relatively well into a reasonably comfortable welfare state, entering a period that would be known to Britons as the consensus. For it was not simply monetary rules and financing that was being provided. The United States had given Britain a new ability, which provided the Britons an avenue toward great wealth. The United States had given Great Britain the ability to make dollars. The system worked like this. A bank in Britain would be able to purchase US Treasury debt, and with that debt issue loans in US dollars. It's as simple as that. Think mechanically about this. Assume a bank in London acquires $1 million of US Treasury bonds. To its customers, it may issue $10 million in US dollar loans. So where did that $9 million come from? It was not in the Treasury bonds that were purchased by the bank, nor was it from depositors. The bank simply wrote loans denominated in US dollars, far in excess of the reserves that they actually had in US dollar treasuries. The banks created new dollars. Throughout the 1950s and 60s, the market for US dollar-denominated debt would explode in Britain. It would then spread across Europe, and by extension, the world, as European banks overseas began writing US dollar loans, and with far looser lending rules than existed in the United States. Those loans would be used to create more loans, securities to create new securities. What would begin as small reserves of US Treasury bonds would be rehypothecated into an enormous market for US dollars. This allowed British financial institutions to do quite well, far better than what any observer would expect. And in turn, as more European banks began to adopt this practice, they too generated enormous wealth. Beginning in May of 1947, the International Bank for Reconstruction and Development would issue its first loan, a loan of $250 million to France. The International Monetary Fund, on the other hand, would focus on more short-term debt, extending liquidity to strained countries. Very shortly after receiving the IBRD loan, France would become the first recipient of an IMF loan. As the years would go on and the Marshall Plan would be underway, the IBRD would shift away from the immediate needs of war-torn Europe and begin financing much larger infrastructure projects, becoming the Anglo-American World Order's International Investment Bank, financing substantial projects in developing nations, projects like power plants, rail, irrigation, and transportation, the source of enormous infrastructure projects upon which nations rely. In 1956, this would go even further, and the International Finance Corporation would be established. What had begun simply as the Reconstruction Bank for Europe was beginning to grow into a much larger, multifaceted international bank. Throughout the following decades, these would become the institutions of the World Bank Group. In 1960, the International Development Association would become a part. In 1965, the International Center for Settlement of Investment Disputes. And in 1988, the Multilateral Investment Guarantee Agency. This was becoming the Orders Bank, and it was enormous. In 1956, as the Suez Crisis was putting strain on Britain and France, it was becoming clear that the land-based territorial empire of Britain was crumbling. The IMF would issue a sizable loan package to Britain, and it was around this time that the IMF began to take on the role of an international crisis manager. When a crisis was rattling a nation, the IMF would be available to step in and provide immediate liquidity, extending lines of credit to allow countries in the midst of a crisis to stabilize themselves until they were able to address it. And while this was enormously helpful to some countries, it did give enormous power to the Anglo-American financial empire. The order that the likes of people such as Keynes had envisioned was at its core the extension of the British financial system, the system which had made its way into the United States. And it was such that now, whenever a country was in need of immediate liquidity, their savior would be the order itself. This would be a very powerful avenue for securing hegemonic influence. And as the world entered the 1960s, it was becoming clear that the world ran on US dollars. The international financial system was denominated in dollars, that the banks of London and Europe were the providers of dollars to the world's economies, and that the Anglo-American Bretton Woods banks were both the Anglo-American order's enforcer of monetary order and the world's lender of last resort. The system was firmly entrenched. It was a dollar world with currency convertibility and gold underlying it. Yet, as offshore dollar loans became larger and larger, deviating further and further away from the actual reserves of treasuries which existed in these banks, the actual reality of the gold which underlay US dollars, and by extension US Treasury bonds, was beginning to become a real problem. In 1971, Swiss and French banks would make a claim on the US dollar. They took the vast amounts of US dollars which they had created via rehypothecation and went to the US, demanding gold for their dollars. While up until then the system had worked quite marvelously, it was beginning to become evident that there couldn't simultaneously be the ability for European banks to create their own dollars and the guarantee that dollars could be converted for gold. Stuck in a very difficult situation, President Richard Nixon had very little option, and thus he would suspend gold convertibility. There was no longer a gold standard for the US dollar, and the currency which underlay the entire world's economy was now pure fiat. Bretton Woods had ended, and the fiat world of the eurodollar had begun. In the 19th century, the world was financializing, and financializing rapidly. The mighty empires of Europe were as much physical territories on a map as they were vast networks of businesses, banks, investments, contracts, and relationships. And as the banking classes of these great European empires found that their financial needs were becoming more and more sophisticated, they began to look for means to coordinate finance across nations. The prominent German Jewish banker, Mayer Amschel Rothschild, would send his sons across Europe, and as those sons became mighty bankers in their own right, some vastly surpassing their father, it seemed that they had figured out how to coordinate international finance. Particularly sons Nathan in London and James in Paris would begin coordinating between their two banks, particularly on matters of the gold trade. the coordination between the brothers allowed them to surpass their peers. They were able to conduct international finance on an order that nobody else could. Particularly under the influence of Rothschild brothers, in 1825, the Bank of France would loan £400,000 in gold to the Bank of England, beginning an era where not only were merchant bankers coordinating, but now central banks were as well. At this point, the financiers of London, Paris, Amsterdam, and Geneva had become among the most powerful men in the world. For as at the heart of these great empires beat a financial machine, it was perhaps more their empires than it was any kings, navies, or armies, and through financialization, they had figured out how to rule over the planet, often without firing a single shot. In the 1860s, as the United States would be plunged into its civil war, the European imperial banking factions would support the Confederacy. They would extend credit, arrange blockade runners, provide for men and materiel, and even arrange for the sharing of intelligence, for their system had become dependent on poor commodity-producing nations staying as commodity producers. For as the power of pricing commodities had begun to leave physical markets and be centered in the financial hubs of Europe, these bankers found that they had the ability, through the trade, market-making, and financing of financial derivatives, to depress commodity prices, or elevate them should the need be. And as they had control over commodities, it was in their interest that the United States be a commodity producer, neither with the industrial might to rival their finished goods capacity, or the financial power to challenge their hegemony. The central bankers of Europe would work quite closely during this period. The Bank of England, Bank of France, and Nederlandsche Bank would begin opening swap lines with each other and holding conferences on monetary policy, now explicitly coordinating with each other. For while these nations were rivals, to great extent, these banking factions were international, and their interests were served when their policies were international. Particularly at the top of this order was the British Empire. Their foreign policy began to adopt internationalism as one of its precepts, for if they could align international policies, they could align them to the interests of London finance, and by extension, the empire as a whole. Yet for these years, cooperation was largely informal. There were no true explicit policy arrangements, but that would all change with the First World War. As the First World War raged, central bank coordination would become explicit and formalized. The Federal Reserve Bank of New York, Bank of England, Bank of France, and Bank of Italy would become connected via telegraph lines, where their governors would coordinate, ensuring that their actions were in the best mutual interests of the Allies. Yet it would be the years after the war where the greatest changes would occur. In 1929, American economist Owen Young would devise a program for the restructuring of German war debt. At this point, the role of German war reparations had become central to the world's financial system, for Britain and France owed America an enormous amount of money, and Britain would only be able to pay back that debt if it received reparations from Germany. Thus, the entire credit system of the world, a world which was becoming increasingly levered, all hinged on one underlying cash flow: the German economy. Thus, with everyone so sensitive to Germany, the Allied governments began creating programs in order to ensure that Germany would make payments. In January of 1930, the Hague Conference would be held. Representatives from the United Kingdom, Belgium, France, Germany, Italy, Japan, and Switzerland would attend. With the needs for financial coordination across Europe on everyone's mind, the central bankers of Europe and their delegates proposed a centralized institution, a central bank for central banks, and thus, in May of 1930, the Bank for International Settlements would be established. Originally, its primary function would be the facilitation of German war payments and the dense web of credit claims and contingencies which had come to encircle the West. Yet as the Great Depression would sweep across the world, they shifted their role to being the financier of short-term credit to central banks. When a central bank of the West was in crisis, the Bank for International Settlements would step in to provide them short-term liquidity. This would continue throughout the 1930s, an international central bank of banks, facilitating transactions and providing emergency short-term funding to central banks. Yet as the Second World War began, something quite remarkable would happen. For despite the war sweeping across Europe, the Bank for International Settlements would continue operations. They would facilitate transactions for the Bank of England just as they would for the German Reichsbank. But more than that, more than being a sort of utility, they became the Club for Central Bankers, a back channel where central bankers from allied and Axis nations could converse and plan. For while the nations of the West were at war, their central bankers were still working together. As representatives joined together at the Bretton Woods conference, many, particularly the American representatives, believed that the Bank for International Settlements had become superfluous, that with the new mighty Bretton Woods institutions there was no longer a purpose for the bank. Yet the central bankers and the representatives of the banking hubs of Europe disagreed. They fought strenuously for the bank to remain, particularly figures like John Maynard Keynes, the British peer, politician, and economist, Montague Norman, the highly notable Bank of England governor, and Per Jacobson, who would later become the director of the IMF, would lobby vociferously in support of the institution. They believed that it could be useful for European reconstruction financing, for maintaining currency convertibility and stability, and to provide banking functions to central banks. Yet more than that, it was the club of central bankers. It was where central bankers went to meet, discuss, and plan their policies. It gave them a degree of control, for this enormous financial institution in the heart of Europe allowed them to enact banking power on a grand scale they couldn't otherwise. It was the perfect culmination of European central banking, and thus, with its fierce defense, the Bank for International Settlements remained, and would continue as one of the post-war banking institutions. In the 1950s, it would serve as agent for the European Payments Union, a multilateral clearinghouse which existed to maintain currency convertibility. In the following decades, it would form group arrangements, creating consortiums with the goal of supporting member currencies, such as an effort to support the British pound during the 1960s. This nexus would only become more powerful as the 20th century went on. In 1974, central bankers would establish the Basel Committee on Banking Supervision, issuing the Basel I Capital Accord in 1988. The goal was for the central bankers of the West, those under the dictates of the new financial regime and the mighty banking hubs of Europe, to set rules and regulations for all banking. They took it upon themselves to become the regulators of the world. In 2004, their rules would be updated with Basel II, and following the 2008 financial crisis, a third iteration would be created, Basel III. It would set up rules like capital adequacy ratios, creating rules for lending and collateral, the sorts of assets that banks must hold. And particularly after 2008, the central banking-dominated world would become perhaps an even more explicitly coordinated international central banking regime. And at the heart of it all was Basel, Switzerland, and its mighty institution, which served as regulator, financier, agent, and club for central bankers, the Bank for International Settlements. Throughout the 19th century, the empires of Europe had come to develop a system based on global commodities. For as these imperial networks of territory, businesses, and infrastructure sprawled across all the world, the financiers and businessmen at the top were best served when commodities were cheap and there were commodity-producing nations with inexpensive labor readily available, ready to provide them commodities for little cost. A process began to emerge. An imperial financier would arrive in new land, teaching the inhabitants that if they were to make only one or a few commodities, then they could be far more prosperous than they would otherwise. The inhabitants would be quite surprised at this idea, for how could they live on only a few commodities? The imperial financier would pitch that they would have a unique comparative advantage if they became the best producers of those commodities. Then he could sell their goods, and they would end up with much more wealth, able to buy the rest for themselves, far more prosperous than if they had to make everything at home. Appearing to be their friend, he asks for only a small cut. Yet when he returns to the banking hubs of Europe, he, through his bank, creates money for himself. He goes into the commodities futures market, and with that newly created credit, drives down the price of commodities. Unable to compete, the commodity producers find that the profits just aren't there. They must take on debt which the imperial financier happily provides. Yet as this continues, the empire becomes more and more entrenched in the commodity-producing nation's government, sending their boys off to war, all while keeping commodity prices low, forcing them deeper and deeper into debt. Eventually, the producing nation implores the financier, saying that they just can't pay him back. Yet, with the smile on his face, once again saying that he is their friend, he tells them that their debts can be forgiven. They need only give him their lands, their farms, their resources, and that they do things his way, by executing a theft in far-off banks and exchange halls. The financier has been able to take everything from the commodity-producing nation, all without them ever seeing what was happening. Now, to the man who promised them great fortune, they owe everything. They no longer even own their own land. This became the basis for an imperial mechanism that stretched across the world. And as the 19th century went on, British foreign policy began to reflect internationalism. The most prominent figures at the top of British imperial politics, figures like Prime Minister William Gladstone, Prime Minister Benjamin Disraeli, Foreign Secretary Lord Salisbury, and Foreign Secretary Lord Granville, would begin converging on a philosophy of liberal internationalism. The philosophical notion was that the world was best off when it was overseen by the British Empire, and when its liberal philosophy was spread around the world. There was a foreign policy dimension to this, certainly the establishment of hegemony, as well as the rather Protestant liberalism that had come to form the core of modern British thought. Yet there was a commercial and financial element to it as well. They became proponents for free trade, but for other nations. They sought to make more nations of the world open to their industry, to their trade and their finance. And by extension, by integrating them into the London financial machine, they would be able to use finance, particularly debt, to assume direct control over these nations. British internationalism was as much about philosophy as it was a sort of grand-scale mergers and acquisitions, but on the order of nations. The United States, however, operated on a quite different philosophy. Though its economic system had gone through many iterations, at its core, it was a synergy of the philosophies of Thomas Jefferson and Alexander Hamilton, a system which would become known as the American system of political economy. It was highly productive, and created an economy which Britain sought to regain influence over. Particularly during the presidency of Woodrow Wilson in the 1910s, it seemed as though Britain's foreign policy establishment and the financiers of London had gotten their chance. By this point, the British foreign policy establishment had coalesced around their unique model of British liberal internationalism, particularly driven by figures like Halford Mackinder and Lord Milner. British internationalist think tanks had become the very heart of the British foreign policy establishment. They had a vision of British globalism, a system of international free trade and finance, one brought under the philosophic vision of British liberalism, and at the heart of it, the City of London's financial machine. With the prime ministership of Lloyd George, This school of thought had clear dominance over the British state, and now it was seeking to take hold in the United States. Edward House was an extraordinarily influential advisor to President Woodrow Wilson. House was the son of Thomas House Sr., a blockade runner for the British during the Civil War, supplying the Confederacy on behalf of Great Britain. He had sent young Edward to the Houston Academy in Bath, inculcating very early on in his son a connection to Britain, teaching him of his British roots, and imparting a belief that that was where his loyalties lay. He would become among the most influential figures to Woodrow Wilson, with reports of an offhand comment where he asks, "What shall we have Wilson say next?" Through House, the British foreign policy establishment worked its way into the White House, taking a man who had campaigned on staying out of the First World War to jumping in with both feet on the side of Britain. Wilson himself was philosophically aligned with progressivism, a system in line with British progressivism and Fabianism, and now with House, both domestic and foreign philosophy was coming to match that of Westminster. Throughout the Wilson years, and particularly during the First World War, British internationalism and finance made their way into the United States at a level that they had never been able to prior. Yet, following the war and the end of Wilson's term, Britain's progress slowed. However, during the presidency of Franklin Roosevelt, they would get their chance again. Roosevelt found himself surrounded by the same figures who surrounded Downing Street, having the same friends and operating in the same milieu as those who made up Chatham House and the Round Table, the think tanks at the heart of the British foreign policy establishment. Yet, unlike Wilson, Roosevelt retained some strong reservations about the British system. Nonetheless, throughout the Second World War, the governments of the United States and Great Britain began to integrate more and more, and thus, when Roosevelt would die in April of 1945, the British foreign policy establishment, intelligence agencies, and financial class were all in place. The notion of an Anglo-American system had been born. No longer were there only the separate nations of Britain and America, but there was the concept of a new entity, Anglo-America. The foreign policy establishment and the financial institutions would be waiting as the post-war order was to be designed. And as the later years of the 1940s came to a close, with new institutions, new rules, and new policies implemented, British internationalism had become Anglo-American globalism. The post-war order was Anglo-American, and the century-long campaign for Britain to reassert its influence over the United States was complete. British institutions found new homes in the United States, and the global world order mirrored British liberal internationalism precisely. While New York would become the new heart for capital, London would take on a more subtle, though in some ways perhaps more influential role. London would serve as middleman, market maker, and broker, at the heart of the Atlantic, continuing its influence over global finance, and with the Bretton Woods banks and Bank for International Settlements as the new most powerful financial institutions, the financial order upon which the British Empire had run for the past century was now fully entrenched, out in the open, and had become the post-war order itself. While the financial machines of the European empires had figured out how to take over countries, the post-war financial institutions would manage conquest on a grand scale. Beginning in the 1950s, the IMF began pivoting to assume the role of crisis manager, early on dispensing emergency financing to the UK, France, and Egypt in the wake of the Suez Crisis. And throughout the years of the 1960s, the World Bank would begin infrastructure financing to more of the world's poorer countries, particularly large investments in India and Brazil. And while these years were reminiscent of what the old imperial banks had done, the raw power of this machine would begin to become evident in the 1980s. Beginning with the Latin American debt crisis, the IMF and World Bank would begin a neoliberal project of structural adjustment programs. They would provide financing to countries in financial distress. Yet, unlike a typical loan, it didn't simply ask to be repaid in kind. For these loans came with steep covenants. They demanded austerity measures be enacted, national industries be privatized, regardless of the wishes of the public, for the government to impose liberalization, forcing the culture to adapt to a Western way of life, and to accept Western business in their lands. While this would begin in 1982 with investments in Mexico and Latin America, throughout the 80s and 90s, this program would be tested around the world. Countries like Ghana, Jamaica, Zimbabwe would begin receiving IMF and World Bank loans. These would be necessary for their stabilization and for their infrastructure. They would force these countries to cut public spending on initiatives like health and education, force them to privatize industry, devalue their currency, and much as had been seen in the British system of the prior century, they would force these countries to adopt policies of free trade. But more than that, they would require that they make their economies open to Western businesses and finance. This would result in riots, as people in the nations receiving these loans felt that their sovereignty had been eroded and that foreign financiers were running their countries, a feeling which was true. In the late 1990s, the Asian financial crisis would emerge. The IMF would arrange large bailout packages, with particularly sizable ones going to South Korea, Thailand, and Indonesia. And while the scale of these bailout programs was becoming larger and larger, it wasn't the scale that was the real shift. For beginning in 1996, the World Bank and the IMF began a debt relief initiative, focusing on countries which they termed as heavily indebted poor countries. The program was that they would forgive the debt of these nations in exchange for policy changes. Was this out of the goodness of their heart? Well, no. It was the exact same thing that we had seen the past century. The poor commodity producer becomes indebted to you. You keep the price of commodities low. They're bankrupt. You tell them that all will be forgiven, but that you own their country now, and that they will do things your way. It was what we had seen for the past century, but far, far grander. Countries of the world would begin rejecting these institutions, while in the West their image would be propped up as virtuous and humanitarian, the financial arm of liberal goodness. For much of the world, they were thought of as villains, just another form of imperial bank out to rob them. In 2001, after years of IMF programs, Argentina would default on their debt. The IMF would offer them emergency financing, yet in a shocking move that was noticed by countries around the world, Argentina would say no, for they figured that it was better to enter true financial crisis than to be on the hook to the global order's banks and what they knew was at the end of it. During the 2010s, IMF funding would hit Europe, as the Eurozone debt crisis would spiral. This would result in severe austerity measures, particularly imposed on Greece. Yet more than that, it would force countries of Europe to adopt the policies of the countries at the top of the European Union, countries which remained hesitant of some of the EU policies and systems would, in exchange for their debt financing, be forced to accept France, Germany, Belgium, and the Netherlands EU. They would continue in this vein throughout the 2010s, though with more and more nations becoming skeptical and many outright hostile toward the global order's banks. The IMF would begin one of its largest programs ever, their COVID financing initiative. The IMF would extend emergency liquidity to over 80 countries, initially with quite light terms, making many countries feel that perhaps this time was different. Perhaps this time the financiers of the liberal world order were their friends. But these hopes were quickly dashed, as they began to impose their usual austerity, policy changes, and now increasingly social changes on these nations. The terms that were attached to these loans had become so completely detached from finance and economics that it was hard to believe. Many nations of the world would be shocked when they found out that the money they needed for critical infrastructure or to get through a crisis came attached with it that the government must show support for homosexual marriage, transgender surgery, mass migration, or even social sexual libertinism with the education of prepubescent children. If you wanted your IMF money, you had better get on board with the most leftist Californian school district. The terms were clear. You become part of the global empire the empire which controls the price of your commodities, or you stay poor and worse. The banks of Europe, with the ability to create US dollars in the Eurodollar credit market, push down the price of commodities in the commodities futures market. The poor commodity-producing nations find, as their economies degrade, that they need bailouts. The superbanks, like the World Bank, the IMF, or the Bank for International Settlements, step in, telling them that they can solve their problems, but that they must reorder their economies to serve the interests of Western bankers, and that they must adopt Western liberal social policies. This is onerous enough, but as conditions do not improve for the countries, their commodity prices still depressed, they may find that they default, and once default happens, the truly onerous terms are put into place. Functionally, their governments become run from the West. They do as the liberal world order says, and that is their repayment. More important than getting paid back in money, the order's banks wish to be repaid in power, control. So, what to make of this trade-off? Is it worth having institutions like these? An emergency lender which can bail your country out in a crisis? Certainly there have been many instances where these bailout packages have saved countries on the brink of disaster. The stories are not all bad, but what's the trade-off? Is it worth having that emergency crutch in the short term, knowing that in the long run, you will be folded into a foreign empire? Is having the short-term band-aid worth losing your sovereignty? Well, that's the question that many countries have found themselves grappling with. And as we have moved forward into the mid-2020s, the answer seems to be, at least for a great number of nations around the world, no. More and more nations across the planet are rejecting these institutions. To them, the risks just aren't worth it. Perhaps it's better to go hungry in the short run than be a slave in the long run. Between the control over commodities markets maintained by Western banks, the lingering financial institutions all across the world, from now bygone territorial empires, the conglomerates that stretch across the globe, and now these international superbanks, which offer to bail you out at the cost of your nation's soul. The financial empires that had been built up over the prior centuries showed that even in the 20th century, with the territorial empires disbanded, that they could remain as powerful as ever. These banks occupy a very powerful niche in the liberal world order, not only for their raw financial might, able to dispense billions and billions of dollars, but as places where policies of the ruling factions are planned, and where powerful elites are minted, or at least some of their upper-level bureaucrats. For while they are not likely to mint a truly top-level elite banking family, they will mint some of the most powerful managers of the liberal world order. Figures like European Central Bank President Christine Lagarde had previously served as the managing director of the IMF. One of America's mid-century's most prominent cabinet officials, Robert McNamara, would become president of the World Bank, Deputy Secretary of Defense, and one of the most powerful authors of modern neoconservative doctrine, Paul Wolfowitz, was president of the World Bank. The Bank for International Settlements general manager, Agustin Carstens, had been governor of the Bank of Mexico and previously deputy managing director of the IMF. While these are some of the most notable top positions, this occurs on all levels. The velocity of the revolving door between the superbanks and the governments of the world is astonishing, for the people at the top of the political apparatus are one in the same with the people at the top of the financial institutions who impose it on others. So who does it all serve? It serves the same people it did in the beginning. Back when these institutions were created by the bankers of the European empires, and by the British liberal internationalists, the powerful banking families of London and Europe, the same people who built the empires, who ran the same playbook all those lifetimes ago. Now, it's just in a new form, and more grand. But the apparatus is far more vast. than just banks. The enormous web of non-government organizations, which begins in the cities of the West and spreads across the planet, receives substantial funding and direction from these banks. Projects like USAID initiatives or the Open Society Foundation simply become another avenue for this vast apparatus to work their way into foreign nations, whether by debt or influence, overt or covert. Following the fall of the Soviet Union, this would particularly be on display in Eastern Europe, as these banks would be joined by other international institutions as well as private capital in an effort to build new post-Soviet nations. Operating on the Washington Consensus, they would impose liberalism, trade policies favorable to the West, as well as new government structures, policies, institutions, and leaders. And through the vast amounts of capital that these funds could deploy, they found themselves in the situation where they could choose who would run the infrastructure, industries, and resources of these nations. They would mint the Eastern European oligarchs. That is where many of them come from. The powerful oligarchy at the top of Eastern Europe were minted by these financial institutions of the West. Yet, as the world moved into the post-2008 financial and economic environment, a new project would emerge, particularly driven by the Bank for International Settlements. No longer was the goal general cooperation and alignment between the central bankers of the West, but they would begin calling for explicit central bank coordination. As the years went forward and it became increasingly evident that the liquidity injections following 2008 were simply a band-aid on a mixed metaphor ticking time bomb, it was realized that central bank monetary policy would be insufficient in another debt crisis, and thus the idea went that central bank monetary and government fiscal policy should be integrated, and that this should be integrated across the world. A prime example of this thought can be found in the 2019 BlackRock paper dealing with the next downturn, where they propose helicopter money on a grand international scale. At the same time, the Bank for International Settlements began researching central bank digital currencies, a project which they continue to today, arguing that such coordinated monetary policy would be far easier to carry out if everyone's money was a digital value on a screen controlled by the central banks, and at its core, the Bank for International Settlements. Though many have debated what form a central bank digital currency would take, the BIS bankers seem to have settled on one which is fully programmable and fully visible, one under the total control of the central banks. At this point, multiple BIS officials, as well as General Manager Carstens, have spoken enthusiastically about the ability to turn on and off people's abilities to transact. What marvelous power of capital controls such a currency would provide. They have spoken of two different forms of central bank digital currency, a fully programmable form, which will be what the public uses, and a wholesale form reserved for the bankers, with of course the latter being private and unable to be turned off. What they describe is precisely the dystopian vision that people have had in mind ever since the notion of a central bank digital currency was first raised. So why? And how do they say this publicly? Well, for the simple reason that the vast majority of the people have no idea what the Bank for International Settlements is. What's so remarkable is that in light of the sheer power of these institutions, most people couldn't really tell you what they are, and that's an enormous advantage. For if you're exerting substantial control, particularly in ways that you know people would not be happy with, you're much better off if people just don't know that much about you. So today we sit with more and more governments around the world rejecting these institutions, with bankers and financiers in the United States, East Asia, Eastern Europe, Africa, the Middle East, and South America, all seeking to free themselves from the strangulation of these banks. There's a fight brewing, a fundamental disagreement on how the world ought to be run, whether the liberal world order's hegemony should continue to reign, and whether their financing arms should continue to dominate the world's monetary order. Yet as this war rages, more and more people are beginning to look at the shadows. Look at these institutions and systems which have exerted so much control all these years. For as the world decides which global vision it wishes to live under, more and more begin to look in the offices and halls of the centers of power of the order, and what they find is an empire in the shadows.